Please, okay, let me just give you this logic. If you want to convert from one currency to another, first check which currency is stronger. Like here, $1 equals to 100 naira. So if I want to convert this $200,000 into naira, I need more quantity of naira. So for me to have more quantity, I'm going to multiply this 100 times this 200,000 to get more quantity. So can you see? So it's very, very important, please. So check first which currency. And again, let me give another example. Let's assume again. I made a sales. Maybe there's a sales of 22 million naira. And as at that date, the exchange rate is 1 naira to 200,000. And let's assume I want to convert this 2 million into dollar. I want to convert to dollar. If you look at here, dollar is stronger than because you need 200 naira for $1. So in this case, for me to convert into dollar, I want to convert to dollar here. 2 million into dollar. I need to divide here because I need less quantity of dollar compared to naira. So I'm going to say 2 million naira divided by 200 to get my dollar is equivalent of this 2 million in dollar value. So that's how to convert, do your foreign exchange rate. So that is that. So okay, let's go back to the question now. If you go back to this question, it's called that okay, this question, dollar is stronger than naira. Yeah, if you look at this question. So now the exchange rate as at that time, 31st of December 2005, is 3.6. If you check the exchange rate, it's 3.6. So which means 3.6 is what we are going to use to translate that. So 3.6. So here, remember here, we say dollar is stronger. And we are converting naira into dollar. So we divide. Yeah, we divide. We divide 4860 divided by 3.6 to give us 1350. So 1350 is the. Then of course PP. Then I have inventories. Inventories is 8316. Still using 3.6. If you divide, just divide this and this, you get 2310. Then trade receiving is 4572. You use divide it, it's going to give you 1270. Then cash 2016. 3.6, which give you 560. So that's so these are assets. So let's add everything together. If you add everything, in naira is going to give you 19. In naira is going to give you 19. In naira is going to give you 764. While this one is going to be 5497. So that is how to a kind of. So these are total assets. So now we're going to compare it with equity and liability. Equity and liability. Okay? So remember, this is total assets. For equity, we have share capital with the subsidiary. Share capital with the subsidiary is 1348. And I told you, for share capital, I use historical opening rate. Historical opening rate simply means it's the rate as at the date that subsidiary was acquired. And if you look at the subsidiary was acquired, at 31st of December 2002. So go to the rate there. The rate there, if you check additional information number A, discover that it's 3.75. 3.75 is the exchange rate as at the date the subsidiary was acquired. If you divide now, it's going to give you. It's going to divide. It's going to be 306.4. Yeah. Then that's that. Then retain reserve. There's no short premium. Retain reserve. For the remember I told you retain earning are divided into two. we have pre-acquisition. Pre-acquisition profits. Pre-acquisition profit simply means it's a profit as at the date subsidiary was acquired. And if you look at it here, is this 2876? So we have 2876. Which rate? Also use the rate as at the date subsidiary was acquired. 3.75. So whatever you have is going to give you the rate as at the date. The rate as at the date subsidiary was acquired is not 3. It is actually 4.4. It's actually 4.4. 306.4, 4.4, 4.4 will give you 653.6. Yeah. Then post-acquisition. Post-acquisition. Now for the post-acquisition, remember use average rate. Post-acquisition profit, remember, this is a post-acquisition. 11184 is the post-acquisition profit. 11184. And for the post-acquisition profit, use the average rate. And the average rate, if you look at the question very well, the average is 3.75. That's the average rate. 3.75 is the average rate. So if you divide now, divide 11184 divided by 3.75 to give you 2984.4. 2984.4. Yeah, 2984.4. Now, okay, let me just explain something before we move further. What am I going to explain here is this. You know, when you are translating from one currency to another, remember, if you look at this statement of financial position very well, we are not using only just one rate, we are using different rate. Can you see here? We use 3.6, 3.6, here we are using 4.4. There's no how the dollar version or dollar aspect of the, figure will balance at the end of the day. No, it won't. What's going to happen is that at the end of the day, you are going to have what they call a foreign exchange differences. Yeah, particularly for the dollar value, not the naira. Yeah, the currency you are exchanging to. The total asset, total asset will not be the same thing, because for the asset here we are using the same rate. Will not be the same thing with the equity and liability side at the end of the day. So which means at the end of the day, you must have what they call a foreign exchange differences. And that foreign exchange differences, because of the different exchange rate we apply in translating the statement of financial position, it's either going to give us a foreign exchange gain. That difference can be a gain or a loss to that particular parent company. Can be a gain or a loss. So that's why a foreign exchange gain is part of the equity capital of the company. It's part of the equity. It's a reserve. It's something you take to a reserve and all that. Yeah. It's other comprehensive income of a company. So, in that case, we want to leave a space, foreign exchange. We don't know that it's a gain or it's a loss first, because we have to go and finish computing and find the difference between the total asset. We know the total asset is 5490. So now let's know the total equity and liability side now. Of course, foreign exchange. Just leave a space there. So let's go. Then under the this is equity. The other liability, the only liability we have is trade payable. If you go there for the subsidiary, it's trade payable. And the trade payable is, if you check very well, is 43. Remember calculation 4356. Liability, you still use what they call the closing exchange rate, which is 3.6. So if you divide, it's going to give you 1210. So now, okay, of course, the naira sign will balance that one because 19764. But the dollar sign you are translating into will not agree. There must be a difference because of the different exchange rate you apply. So let's add and see. So 306.4 plus 653.6 plus 2984.4 plus 1210. It's going to give, if you add the total now here, the total actually is 5154.4. That's the difference. So which one is greater now? If you check, the total assets is more than the total equity and liability. It's more. So if the total assets is more than the total equity and liability, the difference is called the foreign exchange gain. If the total assets is more than the equity and liability, the difference is called the foreign exchange gain. But if the total assets is less than the total equity and liability, the difference is going to be called the foreign exchange loss. That is the difference. The difference can be a gain or a loss. Why? Because at the end of the day, there is no how, because of the differences of the exchange rate we applied in translation, there's no how the exchange rate can be the same thing. So let's find the difference now. The difference between 54, so minus 5490. So which means that 335.6 is the difference. So this 335, let me put here. 335.6. So if you add everything now, that's the foreign exchange gain. It's a gain. 335.6. If you add paragraph 5490. So 335.6 is actually the 335.6 actually our used. So that 335.6 is actually the foreign exchange gain. So that's the translation. So now let's go continuation now. Let's go and translate the statement of profit or loss. Since there is statement of profit or loss, remember we say we have to do all the translation. Number 4 now. Translation of statement of profit or loss. Yeah, translation. So in that case, remember we say Naira sign rate and then the dollar sign. So statement of profit or loss now. If you go to statement of profit or loss, we have revenue. If you check very well, we have revenue. The revenue of that subsidiary is 97,125 naira. And remember, we say anything under statement of profit or loss, we use an average rate to translate items under profit or loss account, income and expenses. Yeah, an average rate in this question is 3.75. So if you divide this with this, remember we are dividing by converting to naira, you are going to have 25,900. Then the next is the cost of sales. Costs of sales, also everything there, 77,550 is the average rate. Will give us 20,000. Divide this and see 680. If you minus, you get a gross profit. Here is going to give 19,575. It's going to give you 5,227. Then distribution and admin expense. Distribution and admin expense, we have 5850. Still the same thing, 3.75. You have here 1560. Minus, you get profit before tax. Profit before tax, which is 13 here, 13,725. Then 3,660. 3,660, okay? Then we have income tax expense. Income tax expenses. We have 4725, still the same 3.75 to give you 1260. So if you minus the profit for the year, which is going to be 9,000, is going to be 2,400. So this is a translation of the profit statement of profit or loss. So that's that. So we can now go to the fifth additional information. What to our fifth workings. Remember, we are doing the workings now. Now I want to determine goodwill now. That's number 5. I want to have goodwill. Goodwill, yeah. Because we need to determine goodwill in that foreign subsidiary. We need to determine goodwill. So for the goodwill, remember I will say cost. For the goodwill too, it's the same thing. Remember here, for the goodwill we have the naira sign, the rate, and also the dollar value. Okay. Remember I will say for you to determine your goodwill or gain on bargain purchase, you need to you need to know what is the cost of investment, which means cost of investment simply means the amount the parent company used in buying the subsidiary. Yeah, they paid, so cost of investment. So for the cost of investment, how much? If you go to additional information, number B, they say Harvard acquired 1,011,000 shares in Krakow for $840,000. So the amount was paid in dollar, it's not in naira. Yeah, the parent company paid that amount in dollar. So which means, of course, $840,000. That is the amount. So let's go to dollar sign, dollar place, and put 840,000. But we still need to know the amount in naira, the equivalent of that 840,000 in naira. Yeah, in the subsidiary, because we are not giving that value of 840 in the subsidiary's currency. So we need to translate that in the subsidiary currency. So, and remember, that money was paid as at the day the parent company was acquiring the subsidiary. So which means, and that date is 31st of December 2002. So which means for us to translate it to the subsidiary's currency, we are going to use the exchange rate as at the time that particular transaction occurred, that payment occurred. And as at that date, the payment occurred 31st of December 2002, which is 4.4. So 4.4 naira is what we are going to use to translate that value. So 4.4, remember it's 4.4. Okay, 4.4. So since 4.4, remember we are translating from dollar. And remember we see here dollar is stronger than naira. So here you multiply. If you want to get now to naira, you multiply 4.4 times 840. Please note that we are translating to a lower currency. When you are translating to lower currency, you multiply. Please, if you are translating from higher currency into a lower currency, you multiply. When you are translating from the lower currency to the higher currency, you divide. Please note that. Very, very important. When you are translating from higher currency to lower currency, you multiply the exchange rate. When you are translating from lower to higher, you divide. So that's how. So now I want to go and now. So in that case, we are going to say 840 times 4.4. It's going to give you 3,696,000. 3,696,000. So now we have translated from higher currency to lower currency. So that's why we are multiplying. Okay. The next is the NCI at acquisition. Okay. Now remember, we said there are two methods you can use to determine NCI at acquisition. So you can use proportionate method or fair value. Most of the times, if it's a fair value, the examiner is going to give you that amount, that value of NCI as at the date of acquisition. And if you check the B part of the question, say the fair value of identifiable net assets of Croker were equivalent to the book value at acquisition date. The group policy is to measure non-controlling interest at fair value at acquisition date, and the fair value of non-controlling interest was measured at $270,000. Also, that value was measured at $1. Yeah, $1. So 270,000, dollar. So also we have to also go and convert that amount NCI into naira. Also the same deeds. That transaction was also still using the same. So we now go and now multiply. Now multiply 4.4 times 270,000. It's going to give you 1,188,000. 1,188,000. So we cannot add now. Let's add two figures. Add here. So which means we are going to say here, we say 840,000 plus 270. It's going to give us 1,110,000. Add. Also here it's going to give us here 3696 plus 1188. It's going to be 4,881,000. Yeah. So let's go and less the net asset at acquisition. Net asset at acquisition. The net asset of subsidiary as at date of acquisition. Remember in naira. If you go to that step 2, you see it. Go to step 2. You see the net asset of the subsidiary as at the date of acquisition. Go to step 2, you see it. I think that's a step 2. If you go to step 2, you see the net asset of subsidiary. And the net asset of subsidiary as at the date of acquisition is 4222. That's 4224. Yeah. So also, we need to convert also. Remember, this value is in naira. Still using 4.4 because everything there is as a date of acquisition. This DOA is as a date of acquisition. And so here we are converting the lower currency into higher currency, so you divide. So which means you have to 4224 divided by 4.4. So 960. So 960,000. 960,000. Now, so these things are in 3 naira signs. They're already in 3 naira signs. This is 840,000. Yeah, they're already in naira sign. They're already in 3 naira signs. So this is going to give us 960. They're already in 3 naira signs. So there's no need of this 840,000 because there's only 3 zeros on top. Yeah, plus 207,000 give us 1,110,000, then minus 9. So here we want to now get. So in this case now, we want to get the goodwill now. The goodwill, which is 1110 minus 960. 150,000 is the goodwill. But in dollar, remember it's in dollar. Good, very, very important. It's in dollar. Then again, we want to also get this one in naira. Okay? 4881 minus 4224 to give us 657. This is our goodwill. This we call it goodwill at acquisition. Everything here is goodwill at acquisition because goodwill is determined as at the date of acquisition. Because anytime we acquire parent or subsidiary, we should be able to determine what is the goodwill as at the date the parent company acquired the subsidiary. So now, but note that from the date of acquisition to date of reporting, date of acquisition was 31st of December 2002. That's DOE. Date of consolidation now is 31st of December 2005. So there's now 5 years gap now between the date of acquisition and the date we are preparing now our consolidation, our consolidated financial statement. So which means 3 years. So now you cannot use the goodwill as at the date of acquisition. You cannot use it. Why? Because from that time till now, exchange rate has has gone up and down. So you cannot use this 150,000 because remember 150,000 is already in dollar. You cannot use that because this 150,000 is 2 years, 3 years ago. So you can't use that. You have to use the current exchange rate, which means the goodwill as at the date of reporting now. So which means here, goodwill at reporting now. For us to get goodwill at reporting, look at what we are going to do now. We are going to say 657. The goodwill of the subsidiary in their currency. What's the current exchange rate? The current exchange rate, which means remember now is 31st of. So the current exchange rate is actually we are trying to add. Okay. Sorry, let me add this goodwill again. The 3696 plus 1188 481 minus 4224. It give us 6 here. It's going to give us 657. So 657 using the current exchange, which is 3.6. Let's see what's going to give us. Divide by 3.6 is 182.5. 182.5. So 182.5 is the retained earning as at the date of the report. Now, because it was 10 years ago, and now you want to consolidate, you have to use a current exchange rate now. So which means in this case, the company is gaining. As at 2 years ago, they acquired subsidiary. Their goodwill was equivalent of $150,000. But now it's 182,500. So which means the company has gained as a result of the foreign exchange transaction. The company has gained. The parent company has gained. So there's a gain here. The company has gained, the parent has gained. So the gain here is the difference between the two. Why? Because this is what you're supposed to report, but now this is what you are reporting. So they have been gained by how much? They've gained, I think, by 32.5. They've gained by 32.5. That's a foreign exchange gain on goodwill. That's a foreign exchange gain on the goodwill. Yeah, that's a foreign exchange gain on the goodwill. So now that's that. So let's go to step next treatment. That's number 6. Number 6 now. Number 6 is NCI at reporting. Number 6, NCI at reporting. Non-controlling interest at reporting. Of course, we have naira, rate, dollar. The NCI at acquisition. Remember, NCI at acquisition. Of course, in dollar is in dollar already is 270. We use 4.4. Remember, in naira is now 1188. Yeah. The NCI share of post acquisition. NCI share of post acquisition. Post acquisition profit. Now, if you check very well, our post acquisition profit, if you look at, is the difference between if you go to step 2, if you can remember our post acquisition profit, if you go to step 2, we say our post acquisition profit, we minus what and what? Okay, post acquisition profit. Okay, let's go to post acquisition profit. Post acquisition profit was we minus actually 11,184. 11. So now, the NCI share, if you go to step 2, the NCI share is going to be, remember, it's 25%. 25% of 11,184. So we want to look what's the NCI share of that. So 25% of 11,184 give us 2. Well, this is in naira 2796. That one use average rate to translate it. Average rate. And what's our average rate? We use average rate to translate that. Using which is our average rate is 3.75. 3.75. So we divide now. So which means we have 2796 divided by 3.75. So you get 745.6. So we now add it 2 now. Add it 2. We have 270 plus 745.6. It was 1015.6. So the last step now is group retain earnings, or the last workings. Retain earnings, or group retain reserve. Now we just use dollar, just a dollar. Parents retain earnings. If you go to the question, the parent retain earnings. The parent retain earnings. If we go to step by parent retain earnings, is the parent to retain earnings. Go to the question. The retain reserve for parent is 502. 502. 502. Yeah, 502. So then, of course, parent share of post-acquisition. Parent share of post-acquisition, which means 75% of this 11,184 divided by 3.75. Yeah, divided by 3.75. 75% times 11,184 divided by 3.75. It's going to give you 236.8. So you now add 2. There's no unrealized profit in this question. There's no impairment and all that. So now add 2. You add 2. 502 plus 2236.8 to give you 2738.8. Then the last one is that those foreign exchange gain, will put them together because they are reserve. They go to the reserve. They are like other comprehensive income of the company. So foreign, that's number 7. Foreign exchange reserve. Okay? The first one is in dollar. The first one is foreign exchange gain on goodwill. Foreign exchange gain on goodwill. That's foreign exchange we got on the translation of our goodwill from acquisition to report, which is 32.5. Then foreign exchange gain on translating statement of financial position. Translation on the statement of financial position, which you say is at 335.6. 335.6. So if you add it together, it's going to give us 32.5 plus 335.6. So we get 368.1. So you have 368.1. So that's all the working nature. So the next slide, we have to go and consolidate the statement of financial position. That's what's to consolidate the statement of financial position and the statement of profit and loss. Consolidate the two. That is all. That will be all about the question. Yeah, all about the question. So now we have Harvard, maybe PLC, A, consolidated statement of financial position as at 31st December 2005. Remember, it's in dollar. We are consolidating in dollar. So, in that case, our dollar signs. Yeah. We have our dollar signs. So, in that case, now go ahead and now look at the consolidation. So, for the profit or loss, remember we start with the non-current asset. Non-current assets. Under non-current asset, you have PPE, property, plant, equipment. For parent, if you go to statement of financial position, for parent is 2870. Please. Now, for the subsidiary, you're using the translated value. If you go to step working number, I think 3, you see it. The statement of financial position will translate it. Don't go and use the one in Naira. You're using the one that has been translated from Naira into the dollar. The one you've already translated. And is that one is 1360. If you add it, you get 4220. Then of course our goodwill, if you go to working number, is it 45? You see working 5. You see our goodwill. And our goodwill, remember, we are using the date of reporting. It's 183.3. It's 183.3 upon 2 thereabout. Then that's that. We'll now add these two figures. We have 4220. 4220 plus 183.3. So it gives us 440.3. Yeah. Then the next is the current assets. Current asset. And current asset here, we have the inventories. The inventory of parent is 1990 plus the one that has been translated, that's subsidiary, the one that has been translated, which is 2310, to give us 4,300. Then trade receivable 1630 plus the one that has been translated, the subsidiary 1270, to give us 29. Then we have cash in bank and cash at hand, 240 plus 560, the one that has been translated, that's subsidiary, 800. So if you add these three figures together, 43 plus 29 plus 800, give us 8,000. 8,000 plus 4403, 03.3, give us 12,403.3. That's our total asset. So total asset must be the same to equity and total asset. Total asset must be the same to with equity and liability. Total asset must be the same to with equity. Total asset must be same to equity and liability, yeah, total assets. So let's go and look at equity and liability. Equity and liability. We have share capital. When you're using parent only, is the parent one you're going to use. Yeah, share capital of the parent. So the share capital of the parent is going to be share capital of the parent only. Only parent has 118. Then of course, retain reserve. This step retain reserve. That's the last workings for the good retained earnings. Retain reserve. The return reserve was giving us how much? It's giving us 117. Then our NCI. Okay, we can add this is 118 plus 3017 plus 3135. The NCI, one we compare, that's the one under additional information. So the one under the workings. The second, for the last one, to say 1108. I think. 23. Then we have non-current liabilities. Sorry, okay, part of the reserve here, this is a foreign exchange gain. Part of the reserve. Now, foreign exchange gain, it says 368.1. 368.1. The non-current liability. Non-current liability, you have loans. And the only loan we have is that of the 1927. That of parent. The current liabilities. You have the only current liability of trade payables. Parent own is 5030, but that of subsidiary, you want to just 1210. That's going to give us 6240. So if you add everything to, if you add it, it's going to give you 12403.3. So that is the end of statement of financial operation. So let's do that statement of profit.